This is Gwent Bilo with additional comments on Chapter 8 related to the last three study objectives, the control feature bank account and a bank account reconciliation. Again, we're just covering the control features of a bank and some comments on reporting cash in this narrative. The use of a bank, as indicated, contributes to good internal control over cash. As indicated, it minimizes the amount of cash on hand, creates a double record of bank transactions, not just the books, but also it's being kept track of by the bank. And it allows a bank reconciliation to be done, which should be done timely, to ensure that it's known what's actually available to the company, not just trusting what's in the records, but reconciling it to bank statement amounts. Only authorized employees should make deposits, generally not the person who initially counts the incoming cash or the person who reconciles the bank account. This is a segregation of duties item. There should be separate people performing these duties. It is a very good practice to deposit all cash sales or other incoming cash on a daily basis. This allows the bank statement amounts to be reconciled to internal records of the company by an independent person. Here's just an indication of what comprises a check. I'll let you look at it, the maker, the company, the payee, etc. I'll point out one thing here, that banks are not aware of checks being written out until the check is cleared by them. It's covered by them, but checks should be recorded immediately in the books as a disbursement. Credit cash, debit, whatever expenditure, or even paying off accounts payable, debit accounts payable. An issued check that's not cleared the bank, we'll see later, is an outstanding check, which has to be reduced from the bank statement amount, but the books are stated correctly if they're recorded immediately. Mailing checks out should also be done by a person not responsible for the preparation, if at all possible. This would potentially attempt to avoid a fraudulent diversion of the check to someone other than the payee. Keeping certain perspectives in order here, when we talk about a deposit of cash in the bank from the company's perspective, this is an asset. The bank who receives the cash is maintaining a depositor account, which is a liability account, credit balance. So therefore, as a bank increases a depositor's account, it'll do it with a credit memo, such as collecting notes for a customer or other regular deposits. It will credit the depositor's account. Likewise, the bank will decrease the depositor's account with a debit memo, such as checks cleared written by the customers, checks previously deposited but bounced because there are insufficient funds, other bank charges. So the bank will debit the depositor's account, which reduces the cash in bank on the company's books. Two different perspectives here. A company will typically learn certain activity that occurred in their account by dealing with the bank statement. Mainly timing issues, although it's possible to detect errors either in the books or the bank side by reconciling the monthly bank statement with the amount of cash on the books. Again, a reference to a bank statement. Debit memos from a bank's perspective are decreasing the cash in the depositor's account, such as the bank service charges or NSF checks that were previously deposited but they bounced from another bank. So the bank will charge it back or debit it back to the depositor's account. Credit memos, the bank is increasing the depositor's account using credit memos, either collecting notes receivable, acting as agent for the company, or crediting interest to their account, interest earned. Question. The control features of a bank do not include having bank auditors verify the correctness of the balance of the bank balance per books. This is done by the company itself in a reconciliation of the bank statement to the amount of cash per books. So reconciling a bank account means taking the cash balance per books and comparing it to the balance per the bank statement. Typically, these two amounts will never be the same. Primarily timing differences. A deposit in transit means a deposit made by a company that has been received by the bank after the cutoff before they generated the bank statement. Outstanding checks, checks that are written that have reduced the book balance, but the bank is not aware of them until it clears it, and other bank memorandum debits or credits. Typically, again, time lags are the biggest difference between cash balance per books and a cash balance per the bank statement. Errors can also account for differences between the cash per books and the cash per the bank statement. Here's a graphic of the bank reconciliation process. Each starts with a cash balance amount per the bank statement and per the books as of the end of a period of time, end of a month, and those two differences must be reconciled. Typically, the bank statement will add deposits in transit that they weren't aware of when they produced the bank statement, and outstanding checks must be deducted plus or minus any bank errors. Now, the reconciliation is done by the company, not the bank. You start with the bank balance and make adjustments for known timing differences. A deposit that was made in the last day after the cutoff of the bank has to be added back to the bank balance. It'll appear in the next month's bank statement. And outstanding checks that have reduced the book balance already, but the bank statement is not aware of them until it's cleared. So those are the common timing differences adjusting the bank statement. Balance per books, typically comparing activity on the bank statement with activity recorded by the company. They'll detect items like notes collected by the bank, which should be added to the book balance. This is like turning over notes receivable to the bank for collection, perhaps because the customer is closer to the bank than going to the company itself. Other adjustments are shown here. A bounced check previously deposited that the bank then returns has to be deducted from the books, learning about this from the statement activity itself, as well as printing charges, etc. The adjusted balances of the bank statement and the adjusted balance of the books must agree to the penny. This is just an illustration of how you can approach certain homework problems by categorizing all known adjustments. Either the book amounts will be increased or reduced, or the balance per bank statement will be increased or reduced to come back to adjusted book balance versus an adjusted bank balance. In the end, the adjusted balances must agree to successfully reconcile a bank statement to the amount of cash in the books per the company. Here's an illustration of bank reconciliation for Laird Company as of April 30th, 2012. The balance per the bank statement shows $15,907.45 as cash on hand as of the end of the month. The balance per the books is $11,589.45 as of the same date. And the following data is arrived at by analysis of items in the bank statement versus items recorded in the book. Again, the company would do this to determine what items need to be adjusted in each balance to agree them exactly, to determine the exact amount of cash available at month end. We have a deposit in transit, meaning that cash received by the company was deposited in the bank, but it was deposited after the cutoff date when the bank statement was generated. Therefore, the bank wasn't aware of it at the time of the bank statement, and the bank statement will have to be adjusted for that amount. Outstanding checks. The company knows about this. They've all been recorded, but the bank has not seen them, and so that'll be an adjustment on the bank side. How do you determine outstanding checks? You simply look at what's cleared the bank versus what the company wrote, and the difference is the amount of outstanding checks. Various errors may be detected as cleared checks are analyzed that are included in the bank statement versus the amounts that were written by the company when they recorded the check. Other bank memorandum, various charges by the bank, reducing the available cash in the bank or increasing it. Again, the company would learn these amounts analyzing the bank statement versus what is or is not recorded in the books for a period of time. Taking these four categories and just slotting them in what balance would be affected. For instance, on the book side, any notes receivable of the company collected by the bank would be increased on the book side. Again, coming from information from the bank statement. Any errors in check recording may have to require an adjustment in the book. Again, based on the actual amount cleared by the bank, if it agrees with the check itself. Certain deductions to the book, NSF checks. Again, this represents a deposit previously recorded in the books, but the check bounced, let's say from a customer, and the bank will first become aware of that and reduce the bank statement, and therefore the books must also be reduced. Bank service charges is appearing on the bank statement, must be reduced from the book side. Again, the company learns about this when they analyze the bank statement. Adjustments to the bank, commonly they're timing differences. Deposits in transit, they're not aware of it. It must be added back to the bank balance as of month end. It will appear on the following bank statement, just a timing issue. And likewise, deductions from banks are commonly outstanding checks that have been written by the company and they reduce their cash in their books. However, the bank is not aware of it until it's cleared by the bank, and so therefore an outstanding check is an amount that needs to be reduced from the bank statement balance to reconcile it to the book balance of cash. Preparing a formal bank reconciliation, it's arbitrary, but it's typically common for the cash balance per bank to begin with, so $15,907.45. The cash balance per books as of April 30th, $11,589.45. These are the two totals that will typically never be the same in a large company, but the adjusted totals must be tie out exactly. So we have the deposit in transit being added to the bank. Again, they're not aware of it as of April 30th. It'll appear on their May statement, just a timing issue. The outstanding checks must be reduced from the bank balance. Again, they're not aware of this. The company reduced their book balance, but it's still not yet cleared the bank. In our example, the company found out that it had recorded a check number in error, again, by comparing what actually cleared the bank versus how they had recorded it in their books. In this case, it was an add back to the book. They had over-recorded the amount of the check. The adjustment here is just for the difference, not for the full check amount, but just the difference. NSF check, a bounced check. The bank did not receive the funds when it sent the check through to be cleared by the bank it was written on, and therefore they've reduced the bank balance statement, and we have to reduce the cash balance per books. It's not available if the check has bounced. Bank service charges off the bank statement must reduce the cash balance per books to reconcile it to the bank statement amount. Collection of notes receivable. Again, this is an example of a bank collecting the company's notes receivable on their behalf, acting as agent, and the company becomes aware of this when it examines the bank statement, and at that time it will increase its balance per books. The bank has already credited that amount in the bank statement amount. So the adjusted cash balance per bank, $12,204.85 with those two timing adjustments, and the adjusted cash balance per books, $12,204.85, ties out exactly. We have successfully reconciled the cash balance per bank statement versus the cash balance per books as of April 30th. Now, the reconciliation is not yet complete. We must update the balance in the books. All the items on the lower part of the reconciliation require journal entries affecting the cash balance. The journal entry here for the collection of notes receivable. As of April 30th, cash has increased $1,035. The bank charges $15 for performing this service, so we'll have to record that as an expense. The notes receivable is $1,000, which is reduced from the company's books. Again, the bank collected it on behalf of the company. Interest revenue was associated with that $50. There'll be a credit interest revenue. And there's the adjusting journal entry to take into account that $1,035 was collected by the bank. Actually, $1,050 was collected by the bank, but they charged $15 and withheld that amount. And so the net amount of cash, $1,035, went to the company's depositor's account by the bank. Combination of the note receivable, interest earned on it, less the $15 charged by the bank for performing that service. Our initial data on check number 443 is that it was written in payment to a vendor. The actual amount of check was $1,226 as cleared by the bank. However, the company misrecorded it at $1,262. So the entry the company would have made was to have credited cash $1,262, debit accounts payable $1,262 in payment of the liability. That was an incorrect amount. The learner was incorrect when they examined the cleared check, and which was actually $1,226. The difference, $36, was over-recorded by the company, so therefore it has to restore cash of $36 debit, increasing cash, and crediting accounts payable of $36 because it had overstated the reduction of accounts payable when it misrecorded the check at $1,262. It should have been a debit for only $1,226 to accounts payable. They debited accounts payable $1,262 because they misrecorded it. So just the change is what is required to adjust the book cash correctly. The NSF check, a check was deposited by the bank or by the company. They debited cash, probably credited accounts receivable. That check bounced, and so the book cash must be corrected, in effect restoring the accounts receivable of $425.60 and crediting the cash, reducing it by $425.60. Upon this entry, the company would notify the customer that their check bounced, the receivable was restored, and that the customer still needed to pay this promise off. Bank service charges of $35 or $30 in this case, recorded as miscellaneous expense, crediting cash for $30. And with this final fourth entry here, we see all the adjustments to cash that are made to correct the April 30th balance. Now, the bank statement would not have been received until May 1st, but these entries would be backdated to April 30th, reflecting the fact that the company is trying to arrive at the correct cash available as of April 30th. With this final April 30th entry, we have all four adjustments booked in the cash balance per books. The note collected by the bank, $10.35, withholding $15 service charge. The $36 correction in the overstatement of a check made in payment to a supplier's accounts payable. The $425 is the NSF check that bounced. The company reduces it, and the $30 miscellaneous charge above reduces the book cash balance. So the $12,204.85 adjusted cash balance now agrees with the adjusted bank balance. After this final entry, the reconciliation is complete. Again, first reconciling the adjusted balances, they must agree, and then adjusting the book side for all the adjustments that affect the book portion of it. There are no adjusting journal entries needed for the bank side. The bank differences were simply timing only. We're just taking care of the book side. Question. The reconciling item in a bank reconciliation that would result in an adjusting entry by the depositor is bank service charge. Again, the company learns this from the bank statement. The other items would adjust the cash per bank statement, not per book. Comment on EFT, electronic funds transfer. Why do EFT transfers result in better internal control? There's no manual, there's no check that has to be prepared by the company and handled by company employees. The transfer of funds is simply conducted by instructing the bank to make certain payments electronically. One internal control related to this, though, is those who can instruct the bank to make payments electronically should be restricted to specific employees. This should not be a power given to more than one individual. What are cash equivalents? They are short-term, highly liquid investments that are readily convertible to cash and so near their maturity that they effectively act as cash, the threshold being 3 months here, that if there's a maturity beyond 3 months, it cannot be classified as a cash equivalent. Typically, on a balance sheet, a company will report their cash as cash and cash equivalents on one line. Cash being amounts available in the bank, and cash equivalents being near cash amounts. So the cash and cash equivalents are typically reported on the same line in a formal balance sheet, only because the cash equivalents are so near to be turning into cash itself. Here's an illustration of that. Delta is reporting $4.607 million in both cash and cash equivalents. Again, that line represents more than one account in the general ledger. Cash that is restricted for a specific purpose, for instance, being set aside to pay off some long-term debt, cannot be shown as general cash on the balance sheet. But a separate line, it is cash, but it's a separate line indicating that it's not free for other purposes. It's only cash set aside for a specific purpose, hence requiring separate reporting as indicated. Question, which of the following statements correctly describes the reporting of cash? C, cash is listed first in the current assets section, the most liquid asset.